Welcome to TradeTheMBI.com. This is John. This report is for the 7th, and well, we got a little bit of fill back in there, still above the ABM from a daily standpoint. We had seen the short-term buyers starting to fade off, and so that's just caused, I wouldn't even say it's a retrace per se, as much as just a softening, but we still have the rising red and green. We need the green midterm buyers to move above. The fact that we're seeing steel dip below the shorts here cause for a little bit of weakness, but the orange getting outside the range, that's a good sign for the breakout potential. So there's some positivity with that. Also, NASDAQ likewise was a little bit stronger even, and it may actually break out ahead first, and that would be a significant, because there have been some very big weaknesses going on. Now, the Eurozone is starting to get the effects of the Greek contagion. We're also starting to see rumblings from France, the major drop in poll ratings in Germany. This is going to cause all sorts of fear, not to mention Italy as well, all in the mix as far as major changes taking place within the political structures of these countries, and could have a dramatic effect on whether or not the euro maintains its viability. Now, we're talking years down the road, but that systemic weakness and the contagion fear is going to drive money out and drive money towards America, which is only going to fuel a decline. Now, this is a big problem for central banks because they're really big into getting the euro back up into this range. They already consider it way undervalued, which it depends on your metric, but it's problematic for them. So as long as they can hold the line whenever they get down into the danger zone here where the magenta is, right around that 105 range, they'll make an effort. And believe me, it is hard to buck a central bank. In this particular case, bonds, you see, we're sort of in this holding pattern because you've got expressed weakness in the economies, but there's also that optimism that things may begin to change. But when you're listening to Congress talk about delaying things and that's only going to put pressure on the market lower, simply because the expectation was that there was going to be some proviso for stimulus that might help push things out of the malaise that they've been in for the last decade. And oil caught in no man's land. And as I promised you, gold rising. Now, gold is precursor rising ahead of it, and that's also, I think, part of the euro situation. It's preemptory for a lot of people moving there because some of them are weary to go into treasuries given the fact that potential for rate rises. So this becomes your inflationary hedge, and so in some cases they'll do a split, and you could see both asset classes improve. We saw it in U.S. Treasuries just there on TLT, and so it's not a surprise that it's spreading there. As far as the market goes, it just was a soft breakdown here with a shakeout. Pretty much stayed in the doldrums, went to neutral, semi-positive right about here, and that continued up, but all it did was fill back in to come back and retrace the dip below the red line. Hasn't even quite fully done so. There could still be some continued weakness. You're not really getting into an oversold situation here. We've just sort of stayed in the no man's land. It hasn't really produced anything. As long as that orange stays trapped in between, you can look for more of the same malaise, and that's basically a quick synopsis of where the world is at this particular point. And I think that still the upside bias has the best play, and so on dips that give decent buy signals, I think it's definitely worth taking that despite the gloom and doom, and that's okay. Still going to provide plenty of opportunities to capture little short moves in there, but I don't think you want to get on the wrong side of the potential of a nice 15 or 20 point jump, particularly if things start to break out. There are plenty of shorts already in that are going to force a cover roll, and that's typically how markets rise against the tide of negative perception. And it's usually been a catalyst for the market rally, particularly right after the 2009 range. When we went into 2010, it was the same catalyst that drove the market up. You had small dips that were then bought up furiously as shorts tried to pounce on the next end of the world scenario. And the reality is, with the amount of quantitative easing and that central banks really have the ability to continue to flood liquidity, and that does make a difference. I've always said this for, well, every year you've listened to me, don't fight the Fed. It's just not worth it. As always, trade well though. We'll talk again later.